Welcome back to PipsTalk, where we delve into the exciting world of forex trading strategies. In today's video, we're exploring the intricate realm of harmonic trading patterns, specifically the Gartley, butterfly, and bat patterns. Harmonic patterns are a mesmerizing fusion of art and science, a technique that can help traders identify potential reversal points in the market. What are harmonic trading patterns? Before we dive into specific patterns, let's lay the groundwork by understanding what harmonic trading patterns are. Defining harmonic patterns. Harmonic trading patterns are intricate chart patterns that occur naturally in financial markets. These patterns are a result of price and time symmetry, representing potential trend reversal or continuation zones. They are primarily based on Fibonacci ratios, which provide a roadmap for traders to anticipate price reversals. The role of Fibonacci ratios. Fibonacci ratios, like the golden ratio, 1.618, and its derivatives, play a pivotal role in harmonic patterns. These ratios help traders pinpoint specific areas where price might reverse or continue its existing trend. Now, let's explore the Gartley, butterfly, and bat patterns, three prominent harmonic patterns that traders often use. The Gartley pattern. The Gartley pattern is one of the most iconic harmonic patterns. It's a versatile pattern with a distinct structure. The anatomy of a Gartley pattern. A Gartley pattern consists of the following key elements. 1. XA leg, the initial move. The XA leg represents the initial price move. It can be a bullish or bearish trend. The XA leg sets the stage for the pattern. 2. AB leg, the first retracement. The AB leg is the first retracement from the XA leg. It typically retraces around 61.8% of the XA leg. This retracement sets the foundation for the subsequent moves. 3. BC leg, the extension. The BC leg is an extension from the AB leg. It often extends to the 1.618 or 2.618 Fibonacci extension of the AB leg. This extension is a key element in the Gartley pattern. 4. CD leg, the final move. The CD leg represents the final move. It should retrace around 78.6% of the XA leg. The CD leg's completion marks the potential reversal point. The butterfly pattern. The butterfly pattern, like its namesake, is graceful and symmetrical, but it has a distinct structure. The anatomy of a butterfly pattern. A butterfly pattern consists of the following key elements. 1. XA leg, the initial move. As with the Gartley, the XA leg represents the initial price move, which can be bullish or bearish. 2. AB leg, the first retracement. The AB leg is the first retracement from the XA leg, usually retracing around 78.6% of the XA leg. 3. BC leg, the extension. The BC leg is an extension from the AB leg. It often extends to the 1.618 or 2.618 Fibonacci extension of the AB leg. 4. CD leg, the final move. The CD leg represents the final move. It should retrace around 78.6% of the XA leg. The bat pattern. The bat pattern, like its namesake, is elusive but powerful. It's a pattern worth adding to your trading repertoire. The anatomy of a bat pattern. Bat pattern consists of the following key elements. 1. XA leg, the initial move. The XA leg represents the initial price move, just like in the Gartley and butterfly patterns. 2. AB leg, the first retracement. The AB leg is the first retracement from the XA leg, usually retracing around 38.2% or 50% of the XA leg. 3. BC leg, the extension. The BC leg is an extension from the AB leg, often extending to the 0.886 or 0.886 Fibonacci extension of the XA leg. 4. CD leg, the final move. The CD leg represents the final move. It should retrace around 88.6% of the XA leg. Trading harmonic patterns. Trading harmonic patterns is an art that requires patience, discipline, and a keen eye for detail. 1. Identifying patterns. The first step is to identify the pattern forming on your forex chart. This involves spotting the XA leg, the retracements, and the extension. 2. Confirming ratios. Verify that the key ratios, like the 61.8%, 78.6%, and 88.6% retracements, align with the pattern structure. 3. Wait for confluence. Traders often look for additional confluence, like support and resistance levels or other technical indicators, to confirm their trade decisions. 4. Set entry, stop loss, and take profit orders. Determine your entry, stop loss, and take profit levels, and manage your risk diligently. 5. Monitor price action. As the pattern unfolds, closely monitor price action. Be prepared to adjust your trade or exit if the market behaves differently. The risks of harmonic trading patterns. While harmonic trading patterns can be highly effective, they are not without risks. 1. False signals. Harmonic patterns can sometimes generate false signals, leading to losing trades. Always verify your analysis with other technical and fundamental factors. 2. Subjectivity. Interpreting harmonic patterns involves some subjectivity. Different traders may identify slightly different points for the legs of a pattern. In conclusion, mastering harmonic trading patterns like the Gartley, butterfly, and bat patterns can be a valuable addition to your trading arsenal. It requires a keen eye, technical analysis skills, and discipline. If you found this video informative, please subscribe to PipsTalk for more insights into forex trading, strategies, and market analysis.